Hey, what's up, everyone? Welcome back to my world of stocks. So, with the market, being extremely volatile right now, and frankly down a lot this year, with most experts expecting it to continue throughout the year, well, I thought it'd be fun to ask one of those, AI chatbots what it thinks would be the five best stocks to buy on the dip. And more specifically, I chose Elon Musk's Grok AI given his ties to Trump and with all the tariffs going on. I was curious to see what his own platform would say on the matter. So that's what we're going to be doing today. And of course, I'll share my own thoughts along the way for each stock. And for the fun of it, I'll even rank these stocks from best to worst based on my opinion too. So it should be a ton of fun like always. And if you want to support the channel, please consider hitting that like button and subscribing. It really helps keep my channel alive and it means a lot to me. So thank you for that support. But let's just go ahead and jump straight into this list here. All right, so here's how I worded my question to Grok. I asked, assuming the current stock market downturn caused by the Trump tariffs in April 2025 will be a buying opportunity, give me the top five best stocks to buy in your opinion. I know that this is not financial advice, so please do not bother giving a bunch of disclaimers. Just list the top five stocks to buy with a couple sentences for each category of business strength, value, future potential, and dividends if they pay one. Have at least two of the stocks be dividend payers. The other three can be anything else you want. To which Grok responded, here are my top five stock picks to buy during the April 2025 stock market downturn caused by Trump tariffs, based on the assumption it's a buying opportunity. Okay, so here are the results, starting with stock number one. It gave us a pretty interesting one, actually, in Nucor, ticker symbol NUE. And I say interesting because I don't think this is a very popular stock. In fact, I don't think I've ever even covered it before on the channel. But here's what it had to say about it. Business Strength says Nucor is a leading U.S. steel producer well positioned to benefit from tariffs, reducing cheap foreign steel imports, boosting domestic demand. And I do agree with that. Nucor is actually the largest steel manufacturer and recycler in all of North America, which I would assume can actually benefit from tariffs preventing cheaper steel materials and products coming in from overseas. And when Grok mentions that it could boost domestic demand, well, I agree with that too, since Nucor is responsible for around a quarter of all steel produced in America too, which is very impressive. Now for value, Grok says trading at a reasonable price-to-earnings ratio historically, it's likely undervalued amid a broader market sell-off. And again, I think I would agree here as the stock has already fallen over 15% in the past month. And while they do tend to be pretty volatile and even a bit cyclical depending on the broader steels market, well, the stock has also lost close to half of its entire value from the top, which does tend to be a good buying opportunity when it's going through, one of those major downturns, having now lost all the gains that they really made over the past 4 or so years. And so that would obviously get more attractive if it continues to fall, since it already has a PEG ratio that is not only less than 1, but it's also 27% cheaper than the sector, despite this being a market leader. Now for future potential, Grok says with potential infrastructure spending and onshoring trends, Nucor could see sustained growth as U.S. manufacturing strengthens. And another thing here that I mostly agree with, whether it actually, happens, may be a different story, but Trump did campaign on bringing back manufacturing to America with the promise of tariffs helping reach that goal too. And again, obviously some people feel that that's not going to happen. Some people feel that it will happen. Regardless, the point is that if it does happen, well, then, I would imagine that it benefits greatly a domestic steel producer like Nucor, who in fact last year completed 2/3 of their massive $10 billion strategic investment and expansion plan, which is now expected to help their earnings per share recover in the coming years. So my guess is that Grok sees the situation here as, a currently falling stock price with rising EPS in the coming years, and that could set up for a nice rebound in the stock. And for dividend, it says offers a solid dividend yield of around 1.9% with a history of consistent payouts and modest growth. Now, unfortunately, at that low of a yield, it's not something that would, entice most dividend investors out there. However, I will say that this is actually a dividend king stock, meaning that they've grown that dividend for over 5 decades in a row. And with such a low payout ratio of less than 25%, I can see why it's not likely to ever go away either. So from that perspective, I do think it's a decent all-around type of stock where you get a good valuation, decent enough business, and a small but reliable dividend. It's not really exciting enough to get me, really wanting to go out and buy the stock though. So I think I'll put them somewhere around the middle for now at number 3. However, I can absolutely see why other investors would want to own it. And I think it was a relatively easy or kind of safe pick here by Grok. All right, moving on to the second stock, we actually have another one here that I don't think I've ever covered before. And that was in ONEOK, ticker symbol OKE, which Grok had this to say about it. Business strength, a major midstream energy company with extensive pipeline networks insulated from tariff volatility due to its focus on domestic oil and gas transport. And yeah, actually, pretty good point there by Grok. Trump ran on really opening up the floodgates of American oil and gas. So why wouldn't a big player like this probably thrive in that type of environment? With not only a huge 60,000-mile pipeline network across around like the Midwest kind of area, but also several growth projects under construction too, and even new giant acquisitions like the $19 billion it spent on Magellan Midstream Partners in 2023, and the $6 billion they spent on Medallion Midstream, and a 43% interest stake that they took in EnLink Midstream as well, which happened last year. All moves that really should help them continue their current streak of 11 consecutive years of EBITDA growth on the bottom line, helping them also maintain their dividend, which we'll touch on in just a second here. Now, for value, it says at a forward PE of around 18, it's a stable pick with strong cash flow generation, even in turbulent markets. Well, not only is the stock down over 18% just in the past week alone, but it's also down over 30% from the recent highs. However, I have to disagree a little bit here with Grok on this being like a cheap value, because even though I got an even lower PE ratio of 15 from Seeking Alpha, the valuation is actually a bit rich for most oil and gas companies, which tend to trade at some of the lowest valuations on the market. Hence why ONEOK is actually close to 50% more expensive than the sector, despite the recent drop. By the way, I hope I'm pronouncing that correctly. I'm pretty sure it's pronounced ONEOK, but yeah, let me know down in the comments if I'm getting that off. Anyway, on future potential, Grok says Trump's energy independence push could drive higher domestic production, increasing ONEOK's volumes and revenue. And yeah, this may be enough here for investors when you add on the dividend, for which Grok also says this dividend pays a generous 4.1% yield with a track record of returning cash to shareholders through dividends and buybacks. And I actually get almost a 5% yield from Seeking Alpha. So that is pretty attractive there for a dividend type of stock. Unfortunately for me though, I'm not a huge fan of oil and gas stocks. If I did own one, I have said in the past that it would probably be Chevron, just because I like their amazing large size and their big investments into renewables too for future growth. But in terms of grading this one here, I think maybe I'll give them the slight edge over Nucor, just because the dividend is at least quite a bit larger. So at least with this one, I would get a dividend if I wanted to own it. But yeah, I guess I'll move Nucor down one spot so that I can put ONEOK in its place at number 3. Okay, now while I may not be, a big fan of those first two options, pick number 3 is actually a stock that I do own myself, and that is in NVIDIA, ticker symbol NVDA, which Grok had this to say about it. And by the way, I'm actually just going to start combining the business strength and future potential segments together, because I think that it'll make it a little easier. But starting with the business strength first, it said this: a global leader in GPUs and AI chips. NVIDIA powers gaming, data centers, and autonomous tech with minimal direct tariff exposure. That's interesting. For future potential, it says explosive demand for AI infrastructure and next-gen chips could propel it higher as industries digitize. Okay, so there is a lot there that I agree with, except for maybe the minimal tariff exposure part. But for what I do agree with, look, there's no doubt that NVIDIA is the world leader of AI chips at this point. In fact, a report from CNBC last year showed that they may be controlling around 70 to as much as 95% of the entire AI chips market worldwide, which is pretty insane to think about. And we all know just how really explosive growth that's really provided for Nvidia over recent years, and what's going to likely continue into the future, with sales breaking new record highs every year, and EPS profits just continue to skyrocket right along with it. But when Grok says minimal tariff impact, that's just something that I'm not sure I agree with there, as a lot of NVIDIA's chips are still being sold in China, making up a significant portion of their business. And of course, there's huge tensions between the US and China right now. Now, to be fair, according to Business Insider, they did at least lower that exposure from 21% of their sales in 2023 down to about half that much at 13% last year. But we're still talking many billions of dollars in revenue here that could be impacted, that they generate from the Chinese kind of region. Now, granted, NVIDIA chips are mostly made in Taiwan through TSMC, so maybe there's a way that they can circumvent some of these tariff issues, but I would still imagine that there's going to be an impact there. Even on just the raw materials used, depending on how those are sourced and what kind of networks they're going through it down the supply chain. So it's all something that I just think I would be cautious of as an investor. Now, for value, Grok says it's likely trading at a discount from its high PE of 90 after a market dip, offering a chance to buy into a tech titan. And yeah, that's something that I'll be looking for myself. I really like NVIDIA long term. And when you look at the stock price, it's lost over a fifth of its value this year and over a quarter of its value from the top, leaving, like Grok mentioned, a much lower PE than their previous highs. But more importantly, it's left them with a PEG ratio of only less than 0.7, which is about 55% cheaper than the sector, despite this being a massively dominant player in the space. And to me, that is already getting pretty attractive here, but especially the more that it falls. So I'd be looking to add more, if it continues to fall like this. Now, for dividend, Grok actually says does not pay a dividend, focusing capital on R&D and market expansion. But I believe NVIDIA does actually pay a dividend. I think it's, if they're still paying it, it should be like a very tiny one. It's 0.03%. I don't ever pay attention to it in my own portfolio because it's just such a small amount. But yeah, maybe that's why Grok didn't mention it. But at that small of a percent, it's likely to stick around. Anyway, obviously people are not investing in NVIDIA for a dividend. But in terms of ranking it here, I like NVIDIA much more than the others that we've seen so far. So I'm putting them up at number 2 for now, above the rest. All right, so that's going to leave us now, though, with the final 2 stocks. And coming in at number 4, Grok elected to give us the e-commerce platform provider in Shopify, ticker symbol SHOP, which it had this to say about it. For business strengths, as a leader in e-commerce platforms, Shopify thrives as digital retail grows, with minimal direct tariff exposure due to its software focus. For future potential, it says expanding into B2B commerce and global markets positions it for significant upside as e-commerce penetration rises. Now, I agree with that. I think in a lot of ways, Shopify has really become the top choice for companies to launch their own e-commerce platforms, which is a great alternative offering to something like Amazon that, primarily runs as like a giant online marketplace. But instead, Shopify offers various tools and apps and web building software to construct your own store and even help with some in-person stuff too, like logistics and point of sale. Now, the result has been huge demand for Shopify, with millions of merchants already using the platform, both big and small, at various price points too, to help match your specific needs. And they're even finding new ways to keep growing too, like by integrating more apps through their Shopify app store, where there's already there's many thousands of them to help improve your business. And you can even integrate other shopping sites too, like Amazon, Walmart, eBay, and more into your own platform, and then manage it all in one place on Shopify, which I also think is another game changer, helping them grow even further. Case in point, sales continue to break new record highs, usually growing well above 20% a year, which is very strong, while their EPS profits should also break new record highs in the coming years too. Plus, like Grok mentioned, they're mostly software based, which should, in theory, be a little more resilient to, most traditional tariffs that primarily tax physical goods. Now, for value, Grok says at 75 times adjusted earnings, a market drop could bring it closer to a fair entry point for a high growth stock. And I agree with that, because even though the stock has fallen about 14% this past week, the PEG ratio is still sitting above 1.8, which is also about 20% more expensive than the sector. That's not too bad though for a growth leader like this, and the stock is also down over half its value from its previous highs. But the only thing that kind of eats away at me with this one is that it recently traded for as little as the $20 range, and I just really wish I would have bought it at that time instead. Still, I do really like Shopify, and I agree with Grok here that if it dips more, it will only get even more attractive, but it's still not quite as strong as Nvidia, in my opinion. So I'm gonna bump Nvidia up to number one so that I can put Shopify in its place behind it at number two. Oh, and by the way, Shopify doesn't pay any dividends. All right, so that's going to leave us now with the fifth and final pick here by Grok. And coming in at number five, well, it decided to go with the telecom giant T-Mobile, ticker symbol TMUS. And for this one, I'm just going to combine everything Grok says and then respond to it at once. But here's what it said. So, business strength, a top wireless provider with a strong domestic focus, largely unaffected by tariffs, and essential to consumer connectivity. For future potential, it says continued subscriber growth and 5G expansion could solidify its lead over competitors like AT&T and Verizon. For value, it says trading at an EV to EBITDA of 11.2. It's a premium but justified price for its cash flow and market share gains. On dividend, it says pays a small dividend around 1% with plans to grow it 10% annually, complemented by aggressive share repurchasing. Okay, so the reason I did this one all at once is because while I agree with most of those points there by Grok, I still prefer an alternative to T-Mobile. Now, on what I agree with, certainly T-Mobile has always done a great job marketing and offering competitive plans versus the other two big rivals in AT&T and Verizon, which the merger with Sprint also helped them expand further to the point where they are now considered the second largest by market share, only behind Verizon, according to Statista. However, the stock price has barely been affected by the tariffs, which I suppose is a good thing because, it does kind of show that primary focus on the American market and their business resiliency is holding up well against tariffs. But what it also means is that the stock continues to trade near a record high. And I just think for that price, there's a better option in Verizon. And here's why. First of all, T-Mobile's market cap is much higher, and their PE ratio is more than double that of Verizon's, despite Verizon doing much more in sales, close to double the free cash flow, and it even pays a whopping 6.3% dividend versus T-Mobile at only 1.4%. And while T-Mobile investors would argue that, they at least have better growth, their sales are only rising by a mid-single digit rate at best, which is hardly the type of growth rate that I would want to see from a stock valued more like a growth stock than a value one to have such low growth there. So even though I can respect what they're doing as a business, I just think it's overvalued compared to its peers. Full disclosure, I do own Verizon stock myself, so you could definitely argue that I'm biased, but I think there's a reason why I'm biased. I think there's a reason why I own Verizon over T-Mobile, and those are the reasons. And I'm just being honest with you. You could take it or leave it. But anyway, for this reason, I think I'm gonna put T-Mobile in last place here at number 5, as I just see the least upside potential likely from this one among the list. But there you have it, guys. Let me know what you think about this list. Do you own any of these stocks? And would you make any changes to my rankings here? I'd love to hear your thoughts. As for me, I think it's an interesting group of stocks. I was kind of surprised by it. I was surprised that Grok didn't choose some of the most popular stocks, like Amazon, Google, Microsoft, Meta, Tesla, those kinds of stocks. So I was a little surprised by that. Interesting group of stocks. Maybe not my favorite group of stocks, but I do like Nvidia. Of course, I own Nvidia. And Shopify, I like Shopify actually. I just want it to come down a little bit more. But yeah, those are my thoughts. Thanks again for stopping by, my friends. I will catch you in the next one. I hope you're all doing well. Take care, everybody. Bye-bye.